These selections were made by David, May 1st of last year. You're out of all of them. Two of them have done well, one's down. We'll see where we stand and when you sold them and why. Lear Corporation, it's up 40% since. How'd you do here? I'm guessing you made some money?
We did very well. This was part of our focus in consumer and then through into auto. We own a lot of auto exposure right now. Magna, Linamar, we own some GM. There's a bunch of companies in this space. This is just a play on a recovering global consumer, and it's one that I would continue to buy here at these prices.
But you got out because?
We came out of it to move into some other spaces. We came out of it in September of last year, just around $100, about 103, I believe. But you could buy it here. It consolidated and broke out to the upside and looks very attractive. It's in a good sector.
Gilead Sciences is one you've mentioned on many occasions, up by about a third since you recommended it in early May. Are you out of it temporarily here? Or?
No, we actually own Gilead as it stands today.
Okay.
And in fact, I think it looks really timely. We very much like the biotech sector. Breadth has been expanding very nicely. Gilead has consolidated over the last 4 months and is breaking out today to the upside. I think that there are some potential M&A opportunities they may have, and there's actually been some discussion around activist investors. This is a company that trades very inexpensively relative to, say, a Biogen, and there could be some very good opportunities for them. So this is a way to buy large cap biotech without taking a ton of valuation risk.
And as you said, you still hold a piece of that one.
Yeah, we bought shares. We bought some shares this morning.
Oh, you did? Okay. But that's why our disclosure board said no for the time being. Canadian Natural Resources, CNQ, you recommended. You got out of energy when, generally?
We sold all of our energy between July of last year and on the producer side, end of September. And this is a great company. But that being said, we just think it's a tough sector to be focused on right now. It's a great long life asset. It's a well-managed business. But, you know, they have a very large gas exposure, which natural gas is tough right now. We think that the longer term picture and the near term for energy is questionable. And so I would just stay clear of the group right now.
And do you have any sense as to what sort of fundamentals you would need to see improve dramatically and when that would be before you'd be interested again in these kinds of companies?
We've seen prices improve for the producers and the service companies. And there's been some lift in the price of oil. So that's on the technical side. We don't just make investments based on technicals. We like to see fundamental data show that something's changing for the better. And this is a group that is right now being revised lower from an earnings perspective. We're seeing dividend cuts, and we don't see a catalyst in the near term for significant change. So given the fact that there's an enormous amount of capital out there to support additional drilling, given the fact that there's probably 300,000 barrels a day of uncompleted wells in the U.S. that have yet to come to market, given the fact that storage is getting dangerously close to full, you know, we think that you could see storage full by early part of 2016. We just think that there's lots of downside risk here, and there's lots of other opportunity for us. So you don't have to go bottom fishing, and very rarely is the leadership in the last bull market the leadership in the next bull market. So we want to buy the things that benefit from lower energy prices that are more sustainable.
All right, David, CNQ, Gilead, and Lear Corp past picks. We will come right back with more of your questions. Stay tuned.